Hi there, I'm Doireann Mc Dermott and you're watching Dukascopy TV today. Well, I'm joined in the studio right now by Jean-Pierre Joly from UBIS to discuss the astonishing phenomena of booming stock exchanges, which is actually disconnected from the real economy. Now, Jean-Pierre, you believe what we are witnessing in the stock exchanges is actually just, not what doesn't really go with what we're seeing in the global economy because there's so much sluggish growth. Now, record corporate earnings, small investors are buying again, and of course signs that the US economy is improving. Are these reasonable factors that are actually pushing stocks higher?
Well, I think that the main factor pushing the stocks higher are the low interest rates worldwide. The other factors you mentioned are a bit more difficult to analyze. The corporate earnings for the first quarter, the average in the US, were 1.9% up against the previous quarter, which does, in my opinion, not justify an increase of more than 15% of the Dow Jones, for instance. I think it's far too early to draw such conclusions. Secondly, as far as the stimulus, the QE measures of the Federal Reserve are concerned, it's far too early to confirm that they have a positive impact. Because if the Fed had made the same analysis, they would have probably increased the level of 85 billion to much more. So I think that Mr. Bernanke is also still analyzing the effects and the consequences of the QE policy. And the smaller investor, I mean the retail investor who comes into the market, which is a fact, well, it's not too reassuring because in the past we have seen that when those people get on the buying side, that it's the end of the cycle of booming markets. So prudence for the near future, at least.
And some hedge fund giants are quite concerned about this rally and actually blame US monetary policy. Now, their main concern is that will push inflation higher. Are you concerned about this? And of course, do you think it's just, a big bubble waiting to be popped? And when do you think it will actually be popped?
Well, normally with the artificial low interest rates, inflation should pick up. Nevertheless, since on the demand side, there's very little action from the consumers, this might last for a few months before inflation really picks up. And I don't think that inflation is a big concern. Nevertheless, I agree with the fears of the hedge funds managers that this bubble could burst in the very near future. Personally, I think that the year-end could be the period where the first signs of the burst could appear.
And there are some markets where prices just don't match logic. We especially see this in corporate bonds. Can you give us some examples of this? Well,
I think the corporate bond market is since the beginning of 2011 is quite normal as far as I'm concerned. Prices are quite in line with the yields. And the yields of corporate bonds normally are superior to the government bonds ones. And in this case, I don't see a discrepancy, in fact, in the behavior of the government bonds pattern. Another feature of government bonds is the credit risk, because since corporates have been borrowing quite a lot, and the investors have been very eager to buy those bonds, because compared to the government bonds, the yield is superior, The investor, in fact, lost the credit risk part, and this could, if there's a recession, have some negative consequences, since the corporates will be unable to pay the interest at the first stage, and if things get worse, would be unable to reimburse the principal. So there's a danger on that side, but for the rest, if interest rates go up, well, the investor will be caught with a declining bond value, but that's normal. So.
And one last question, Jean-Pierre. We can't go without talking about Japan and all their quantitative easing and how it's actually having an impact on this massive rally.
Well, it has an impact, it is for certain. Although it's far too early to draw conclusions from the quantitative easing happening in Japan. This was decided only 2 months ago when Mr. Abe came in power. And it was not easy to convince the governor of the central bank. And nevertheless, we have to admit that at the first stage, this package was received by the industry and the banks very positively. And it even encouraged more the investors to buy stocks. Nevertheless, there were some side effects which were not foreseen and which happened for the first time during a quantitative easing exercise. Last week, the interest rates to be paid on government bonds went up steeply, in fact, for Japanese standards at least, and everybody was surprised. It influenced very much the stock exchange, which collapsed nearly for 1 or 2 days. And so quantitative easing, okay, but nobody knows what will be the final effects. Everybody hopes that this will encourage growth, and but nobody's certain. And I think Japan and the United States are doing the same exercise. Japan far stronger than the US, but both are still waiting for the results, and we'll see probably not before the end of the summer what will be the results.
Jean-Pierre, as always, it's been a pleasure having you in the studio and talking about a very important topic like this.
It was my pleasure.
And viewers, thank you for watching Dukascopy TV today. Do tune back to the website for more interesting interviews and press reviews, but for now, enjoy the rest of your day.